Hi, this is Peter from Game of Trades. Welcome to this channel. We're here to discuss the stock market and provide you with a full view of the technical and fundamental picture of what's happening in the stock market. If you're interested in that type of content, make sure to subscribe to this channel for multiple videos a week, and we discuss how to fully take advantage of the stock market, whether that's up or down. We don't care. We're here to profit. So a big theme in our recent videos has been that the market in 2020 is in a speculative type of environment, very similar to what we had in 1999. And that's something that we've discussed many times. We're not going to get too much into that. You can see that just by the similarity in the type of price action that we're seeing right now with this recent powerful move out of the price channel. And again, a move out of this other price channel, very similar to what was happening back in 1999 right here. So other than that, one big similarity that we have compared to the dot-com bubble is valuation. So we've talked about that, and we've talked about the fact that valuations don't tell you whether the market's going to crash or whether it's going to go sideways, up or down. It tells you what type of environment you're in. When you have very high valuations, what does that mean? It means that investors are not only taking into account the actual value of the stock or the ETF, but they're also speculating on top, right? So high valuations means lots of speculation, and low valuation means very little speculation. So you're not very likely to get big wild rides in the stock market when it's undervalued. So right now we know that valuations are high. We know that speculation is high, but the only question is that something that's going to last forever? Or is that something that's about to change? So we're going to discuss that in this video. We're going to put our opinion out there. That's what YouTube is for. So if you have any comments to make, don't hesitate to drop them down below in a constructive manner. We're here. We do read all the comments on the YouTube videos. So we really do appreciate the community that's starting to form on this channel. I'd like to say thank you for that. If you enjoy these types of videos, more focused on the fundamental picture and our opinion on what's going to be happening over the next few years, make sure to hit that like button, because these videos do take a little bit more time to prepare than the usual technical market updates. So now, without further ado, let's get right into it. Let's quickly talk about speculation. Why are we seeing so much speculation in the markets? What is the one factor that's influencing this, and that has been an influence on speculation over the last few years? That is interest rates. So we've had interest rates extremely low. I'm going to show you a chart right now. This is a chart of the 10-year treasury rate, right? So that's what it is, a 54-year chart of the 10-year treasury rate going back to the 1960s. And you can see, we can observe on this chart the big inflationary cycle between 1960s and 1980, right? Where we had a lot of inflation, and so the rates were going up. And then since 1980, we've had a constant downtrend in interest rates all the way to 2020. So what does that mean? That means we've been in an extremely low interest rate environment since around 2009. And so that means borrowing is extremely cheap for companies. They can put on a lot of debt very quickly. So why is that important? The more debt you have as a company, the more you can expect growth in the future. So that's what the market's all about. It's about growth. So if we can figure out the factors that have been leading to this environment, then we can potentially figure out whether they're here to stay or whether we might see a change in all that type of action. And to do that, we're going to go through the factors that influence inflation or deflation, right? Because that's what these rates, these borrowing rates, are all about. If there's high inflation, then rates tend to be extremely high because the demand for credit exceeds the supply of credit. So rates rise. But when we have a lot of deflationary forces at play and you have less and less demand for credit, then you tend to have rates come down lower and lower. So we have been in a very deflationary environment for the last 40 years. Can we figure out why that is? And so the first point I want to address is technology, right? And all you have to do is type this into Google, technology replacing jobs. And the first thing you'll see is that up to 20 million manufacturing jobs around the world could be replaced by 2030. Technology is something that has been set in motion since the 1980s, right? We've had more and more machines, more and more robots, more and more automation replacing jobs. And so is that deflationary or inflationary? You got it. It's deflationary. Because if you're getting replaced by a machine, you're losing your income, you're losing your job, and you have to go and find another job that's not likely to pay as much because they've got machines to do your job for you at a cheaper price. So that's the first big force to understand, technology. And that's something that's been pushing these rates down throughout the entire technology boom, right? That makes sense. It aligns well with the dot-com bubble, right? The rise of Apple, the rise of technology throughout the 80s, 90s, and right now we're still seeing those trends shift. Now let's talk about something else that's had a massive impact throughout the 80s and the 90s, and that's globalization, right? We had a massive increase of manufacturing being outsourced to other countries, right? And so again, let's ask the question, is that deflationary or inflationary? And you got it, it's deflationary. Because again, if your job is getting replaced by someone who's willing to do it for a cheaper price, then you've got less income to spend, and so you're likely to cause less inflation and actually pull prices down. So that's been a big factor, globalization, and you can see since the end of World War II all the way to 2008, this is 2008, the peak of globalization, you had a massive uptrend. So let's talk about that. Is that something that's here to stay, or are we going to see a shift in that movement? And think about everything that's been happening over the past few months, like the health crisis. A lot of companies are realizing that globalization may have went a little bit too far, too quickly, and we're already seeing some companies step back away from globalization, bring back the manufacturing more local, and make the supply chains more reliable instead of efficient. And so if we see that switch in trend where companies look for a reliable supply chain locally, then we might actually see this ratio continue down after the health crisis. So that's something very interesting. And so if globalization was deflationary when it happened, what would this move be? Well, it would be inflationary. You'd bring back a part of the jobs that were lost. So we're going to start to make a list on this chart right here of all the points that we're talking about, and then we're going to put these points into either the deflation camp or the inflation camp, and then we're going to see what's likely to happen in the next few years. Now, the next point I want to talk about is the household debt to GDP, right? Not a lot of people talk about this, but it is something that's very, very important. This is a chart of household debt, right? Debt to GDP all the way back to the 1950s. I'm going to give you a quick crash course on that. The higher the household debt is, the higher the deflationary force. Just apply that to yourself. If you're under a lot of debt, then you're less likely to go out and spend your money. And so that's deflationary. But if all of a sudden you've got no more debt, then you're a lot more likely to go out and spend because you're not worried about being bankrupt anymore. So now that we've understood that, we can take a look at this chart properly. And you can see again from the 1980s all the way to 2008, we had a massive increase in household debt to GDP. So that was a major deflationary force that was building throughout those years, again, pressing down on those rates. But now look at what's happened recently. Since 2008, you've had this debt come back down. So a lot of people right now, despite the health crisis, despite everything that's been going on, are under less debt than they were back in 2008. And we can take a look at what happened the last time you had that type of move down after a big surge. So we can compare that surge in household debt to this surge in household debt, and then this move down compared to this move down. So that takes us around to the end of the 1960s. So let's take a look at what happened to the rates at the end of the 1960s. Right there, that was the bottom of the household debt to GDP, and that's what happened to rates after. So we're not saying the same thing is going to happen right now. We're saying that right now, household debt is down, and so the likelihood of people going out and spending their money is higher than it was throughout this period. And we all know about velocity of money and how velocity of money is something that you need for inflation to appear. You can see that's been dropping down for the past 20 years. So pretty much killing inflation, right? Nobody's going out and spending their money. But if all of a sudden you've got a lot less debt in the average household, then maybe that might be the factor that's needed to change the trend. And we're going to tie that right in to the personal savings rate, because we've just had a major health crisis where a lot of people were locked up inside their home and not able to actually spend and were forced to save. That's called forced saving. And so you can see that's represented by this chart where we had the savings rate absolutely skyrocket back in April. And that's been coming down recently. So what does this represent? If you could actually calculate the area under this line, you would actually get the total amount of money that's been saved up and that's waiting to be spent, right? That's what it is. That's what the area under that line is, the amount of money that's waiting to be spent. And so if the personal savings starts to come back down lower and lower, what do you think is going to happen to inflation? It's going to go up because people will be spending more and they'll be spending what they saved up throughout this period. And we can observe an example of that back here again. Personal savings went up massively in 1975 and then crashed back down throughout the next few years to bottom in 1980. So throughout that entire downtrend, what do you think happened to rates from 1975 all the way to 1980? That was a massive increase in inflation. Again, we're not saying that's something that is necessarily going to happen. We're just trying to fit in all the pieces, and then we're going to figure out the most likely scenario. So now that we've got our list of the big deflationary forces that we had throughout the last 40 years, we can now decide whether they're going to continue being deflationary or whether they're going to start being inflationary. And so first of all, technology, we've discussed that. That's here to stay. We're going to continue seeing major deflation due to technology. Globalization, inflationary camp. The next 5 to 10 years are likely to be symbolized by a lot of manufacturing coming back locally. Household debt, inflationary. People are under less debt, more able to spend. And same thing for personal savings. So no matter how much the policymakers will want you to believe that inflation is dead, we do have major arguments that call for an inflationary environment over the next few years. So now the question is, what happens to the stock market during an inflationary environment? Is inflation good for the stock market? What happens if we see rates reverse and pick back up again, similar to what happened here in the 1960s, 70s, and 80s? And we're first going to take a look at the Dow Jones for that, and then we're actually going to take a look at valuations and see what happens to valuations throughout inflationary periods. And so you can see right here, 1965, around the top of the bull market, right here, this bull market super cycle. And then throughout that entire inflationary cycle, throughout the 60s and the 70s, you had the market go sideways. And actually adjusted for inflation, that looks a lot worse than this. It looks a lot more like this. And the Dow Jones actually bottomed in 1982 when you adjust it for inflation, not in 1974, in 1982. So now let's take a look at the S&P 500 PE ratios. And you can see when you had that switch from a disinflationary environment to an inflationary environment throughout the 1970s and 80s, you had the PE ratio, so the valuations, come down from very high, historically high, to very low. And so where are we right now? We're at very high valuations, right? We're very low interest rates, and so there's a lot of borrowing, a lot of growth expectations, and so valuations are inflating massively. But if those inflationary forces start to come into play and force the rates to go higher, then we might see this bubble start to pop. Now, this is obviously a very controversial discussion, but we always love the feedback on the videos. So if you have any comments on that, make sure to leave it down below. And if you're interested in finding out about how we're positioning ourselves in this future inflationary environment, make sure to go check out our website at gameoftrades.net. We talk about how we're positioning our capital outside the stock market, because we believe the stock market is overvalued, and how we're looking to take advantage of value plays, gold, crypto, emerging markets, where we're entering, where we're exiting, and our entire thesis behind those investments. Now, that's about all I wanted to say in this video. I hope you guys enjoyed this video. If you did, don't hesitate to drop a like to let us know that you're enjoying these videos. Now, in the meantime, good luck on your trading and see you next time.